to expand into alternatives, which, as we know, pays very high fees, and so many investors are flocking to that part of the market now. So there's a lot to capture, a lot of opportunity.
Yeah, Laura, give us a little bit more detail on how PIMCO's alts business has developed over the last few years.
Well, I mean, it's been handed a 90 billion mandate from Allianz back in 2020. So, its alternatives business is around 200 billion. Half of that is with real estate from Allianz. So it has been quite heavy in property. Obviously, property's had a lot of challenging moments over the last 2 to 3 years. So there's been a lot of working out there, some losses and some departures. But they have been very strong in places like distressed debt, where they have a presence in these big capital structures. They're in the steering committees of a lot of these deals if they go a little bit awry. And, there's some very, very sharp minds there, as we know.
Laura, give us a sense of the competitive landscape here, because it feels like every asset manager is trying to get its alts business up to speed. You think about PIMCO in comparison to BlackRock, for example, which has done a ton of acquisitions, it feels like, over the past couple of years to really come up to scale. How does PIMCO compare?
I think, managers have a few choices. One is to try and expand organically, which is very, very slow, and, it can be part of the longer game strategy. Another side is, you can try and acquire, which is what the likes of BlackRock have done. That can be very costly, and many firms don't want to risk diluting or changing their culture or structure internally. So there are challenges to both sides, but what's really key is attracting talent and keeping that talent at the minute, because there's a lot of competition for hiring in that market.
Yeah, exactly. So what does it do to retain that talent, given that there's obviously a little bit of a problem still? Before it was Bill Gross, now perhaps it's Dan Ivison and a few of a small coterie?
That's right. Yeah, I think, incentives are very key. When you have the likes of KKR and Apollo, Dan's made some very, interesting incentives and opportunities. And I think, other managers have to step up to that and be mindful of that. And also just have a great, healthy, constructive culture and strategy going forward in terms of, being aligned on how you build out that alts business. But we've seen many partnerships start to crop up amongst the more traditional asset managers. So we've had KKR partner up with Capital Group. BlackRock, as you mentioned, have been expanding at breakneck speed. Big acquisition for HPS, that's still in the mist. So it'll be interesting to see how other managers try and move in and stay competitive.
Let's talk about fees here, though, because a line that caught my eye in your story is you talk about PIMCO's relative caution carries a risk here of it getting stuck as a lower margin bond shop. And underlying part of this gold rush into private assets is the fact that, of course, you can charge investors higher fees to get that exposure. So talk to us about, what that actually looks like when it comes to the end investor buying into a private credit sort of fund versus just a traditional public bond fund.
Exactly. So the majority of PIMCO's assets are with fixed income. And as you know, there's a race to the bottom in terms of fees. They're just getting lower. The likes of Vanguard and others are keeping everyone on their toes. Whereas obviously in the alternatives part of the market, you can charge some very, very attractive fees for doing more bespoke, interesting, complex, higher risk strategies. So I think that's something that everyone is, keeping in mind. And also for the traditional asset managers like PIMCO and Capital Group, it'll be keeping both sides happy, keeping your traditional investors happy, and also, looking at how you can kind of push into the higher fee part of the market. So there are some challenges, I think, for the bigger managers that have been around for a long time.
All right, Laura, great story, great reporting. Really appreciate your time this morning. That is Bloomberg's Laura Benitez. And Laura mentioned, of course, that race to the bottom in fees. And speaking of, I'll be in conversation with the CEO of Vanguard, Salim Ramji. That conversation coming up at 11:30 a.m. Eastern. Of course, Vanguard announcing its record fee cuts this week. So plenty to talk about there. But let's get a check on these markets right now. You can see the S&P 500 holding on to its gains, up about 0.2%. Big tech managing to find some momentum here. The NASDAQ 100 higher by about 0.2% as well. I was talking about that leadership in the small caps, faltering a little bit right now. You can see the Russell 2000 pretty much unchanged here, but that has been your year-to-date leader. A lot of that depends on the bond market, and the bond market, of course, is where all the eyes are right now, especially when it comes to the Trump administration. And Scott Bessent, our newly installed Treasury Secretary, Bloomberg will speak to him at 1 p.m. Eastern. But coming up in the next hour on this show, we'll speak to Citi Wealth's Stephen Whiting. Then we'll speak to Cummins CEO Jennifer Rumsey on her company's promising growth. And then the CEO of LabCorp talks about how RFK Jr.'s potential confirmation may impact business. This is Bloomberg. All right, we are 30 minutes into this trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Bonnie Quinn. Matt Miller and Sonali Basak are off.
And coming up, stocks rising as investors brace for tomorrow's jobs report and sift through a flurry of earnings. Amazon takes the spotlight after the bell today. And as earnings season rolls on, we'll get the view from the C-suite. This hour, we'll speak to the CEO of Cummins as well as the CEO of LabCorp. And it's yields, not the Fed. Treasury Secretary Scott Bessent says that the administration's focus is on the 10-year Treasury rate. Bessent joins Bloomberg today at 1 p.m. Eastern. All that and more coming up. Let's get a check on these markets. A little bit of a rally on our hands. The S&P 500, the NASDAQ 100, a little bit higher to the tune of 0.1 to 0.2%. The bond market relatively well behaved right now. Scott Bessent will be pleased to see that. You can see the 10-year Treasury yield up about 1 basis point or so. We're hanging out near 440. We certainly have cooled from heights that we've seen in the past couple of weeks. So let's wrap it all together now with Steve Whiting. He is Citi Wealth Chief Investment Strategist and Chief Economist joining us now. Stephen, it's great to have you with us.
Thank you.
It's been a heavy week. We've gotten a lot of trade news. We've got a lot of earnings news. We've got a lot of economic news as well. So let's start with tariffs, because one of the things that we came into this week worried about was the possibility of a multi-front trade war. And from the investor perspective, how do you prepare a portfolio for that possibility?
Well, this is a critical issue. Trade is highly profitable for American firms. We have a trade deficit, but we have a market cap surplus. If you take a look at the U.S. valued at 2/3 of the global equity market or a bit more. So the question is this going to be something that's going to actually disrupt production? Is it something that's going to create great retaliation? Certainly, we're taking a little bit more of a diversified approach in portfolios, emphasizing a bit more income than just the positive aspects of what we're seeing from the administration, deregulation and clarity on taxes, which are all positive. It's causing a rise in business confidence. But tariff risks are meaningful. I think what you saw, though, with Canada, Mexico, Colombia, all willing to give concessions to avoid tariffs is a sign that this does not have to be a disruptive shock.
Which would be a relief to the markets in many, many ways, right, Stephen? But we won't know for at least a month if there's going to be another extension or some other form of wrapping up of this whole, idea of tariffs and whether they should go on or not. And I guess the threat will always be there. Talk to us about what Scott Bessent has been trying to steer the conversation towards. Obviously, once an economist, always an economist. Is it doable? Can a government impact the yield curve lower?
Well, look, the shape of the yield curve is going to be heavily influenced by the Fed. Every Fed easing cycle has resulted in a steeper yield curve. Every Fed tightening cycle, a flatter yield curve. And the mere fact that the Federal Reserve has gone into a hold pattern to assess has in fact helped and assisted to lower those longer term yields. The fact that the Federal Reserve cares very, very much about, in the long run, hitting its inflation target. And even if that costs us something in the near term, that's good for 10-year treasuries, right? And that's why we've seen the yield curve flatten back a bit. And yields back off of 480. We think that the Fed will also be very sensitive to the labor market. What you saw out of the JOLTS data, what we would expect that by mid-year we'll start seeing again is that the labor market will underperform the economy. Labor demand is cooling down some. It's not a collapse in the economy by any means, but the Federal Reserve backed off 100 basis points just on that prospect. So we think that they probably will be easing again some.
Yeah, for sure. And I'd love to get your forecast on that. But I'm specifically talking about Scott Bessent's comments, and that's absolutely independent, or should be, of the Fed. Can the U.S. government, via the Treasury, impact the 10-year?
I don't think it is. Again, the choice of particular borrowings, whether it's bills, whether it's tens, and this focus can probably have a minor influence on what is a massive market with global participation. And of course, in an extreme way, it could influence the yield curve. But U.S. monetary policy is going to have a very big influence at both ends of the curve. And how the Fed conducts monetary policy, where we are relative to the rest of the world, that's all highly meaningful beyond just issuance data.
Yeah, no, it is interesting, of course, to see his comments come out last night after we got the refunding announcement earlier in the morning. I don't know if you can draw a line between those two, but I know that some people are. But let's talk about this idea that, okay, this administration is seemingly very focused on the bond market. And you think about the first Trump administration, it seemed like the focus was on the stock market, on the S&P 500 and the number there. And there's been a lot of question marks about the Trump put, whether it still exists, whether the strike price is much lower than it used to be. I mean, how do you think about that? Obviously, you're a long-term, well-diversified investor. I mean, does it matter to you either way, whether or not the president of the country is focused on the stock market or the bond market?
Well, look, we have to admit to some guesswork here. And the fact that there has been a financial market reaction to tariffs, may have some feedback effects on what the administration chooses. The fact that we lived with 2 years of average 7% inflation, probably has some influences on what exactly the U.S. will pursue. And, what will really please the public. It isn't necessarily, again, the highest tariff level, the highest domestic manufacturing content. That may not be exactly what the public is after. I think that there are real questions here that we don't have answered yet, and maybe the administration hasn't come down to a final decision. When you take a look at tariffs, And you think about this large budget deficit that the U.S. has, this fairly extreme budget deficit. Now, again, there are plenty of them around the world, but how would we address this? How would we address excess demand in the United States being driven up by a budget deficit? And, a lot of economists will tell you what you need is tax increases, right? That would slow demand. It wouldn't leak out abroad. You would lower the deficit. You'd have a smaller trade deficit and budget deficit with tax increases. You could take a look at what tariffs do. It's an attempt to raise revenue, much like a consumption tax, but to discourage foreign imports and to encourage domestic production. I think that they're thinking about it partly that way, but also very much about all sorts of trade aims. So border control, the administration is focused in on Mexico, and the administration's focused in on Europe paying for defense. So it's using tariff threats for all of these sorts of things. So there's some expectation embedded in markets and some of the volatility that we've had that have been driven by tariffs. If you think about tariffs on Mexico and Canada, if they went through, we could collect $260 billion, but that's very far from something that would wreck the economy.
Stephen, thank you so much for your thoughts today. Very much appreciated. That is Stephen Whiting of City Wealth. Now let's get a look at stocks moving at this hour. Bloomberg's Jess Menton joins us. And Jess, we're starting off with Roblox.
This is a pretty significant drop here. So it did drop as much as 30% in pre-market trading. It came off of some of those lows, but still nonetheless, still down 17%. So it's on pace for its worst session since May. But if you put that into perspective with market cap, I mean, that's wiping out around $8 billion at this point right now, if that holds through the close. And right now its market cap is around $41 billion. So what happened here, it's active users specifically for the fourth quarter. It was expected to come in, those anticipations from especially what analysts were thinking of, around 88 million. It actually was around 85 million. And of course, there's been a lot of questions about the security when it comes to the video platform in recent quarters too, and what they were doing with AI and protocols for their younger users, especially what parents were kind of pressuring it. So right now you're starting to see that, and especially the growth is beginning to slow here, and you're really seeing that pressuring the stock.
Yeah, big time. And it really feels like an embarrassment of riches when it comes to big movers today.
Right.
One of those big movers is Peloton. Peloton has been such a fascinating story. Finally got some good news.
And of course, as we know, it's one of those pandemic darlings that has not been able to take out that high that we did see back in January of 2021.
Victim of its own success.
Of course, so it's still down about 90% and more than that since that all-time high a few years ago. But if you're looking at this, up about 13% on pace for its best day since October. Actually, its guidance, particularly for the next year, was better than expected. And then also specifically, because this is for the holiday quarter, they have partnerships with places like Costco, and so that's something that helped drive sales. So you are seeing some optimism there, but still there's a lot of cost cutting and question marks as far as what this means moving ahead.
Well, a uniquely American company, and that's Ralph Lauren. It's up nearly 100%, by the way, year over year, up 25% year to date. Explain to us what's going on with those shares today, up 15%.
It is, and it's interesting because if you're looking at European fashion outlets, especially like Hugo Boss, they're not seeing the same type of growth here. So particularly in the holiday quarter, they saw a lot of growth with younger shoppers here. So when you're thinking, of course, Polo brand is one of the bigger ones that people notice for, as well as when it comes to sort of the Purple Label as well. And then especially if you're just looking at the apparel group in the S&P 500 right now, that's higher. But I have to point out, because Tapestry also reported, and especially because of its Coach brand, you did see that moving higher too in that group. So that's actually up around 15% for Tapestry specifically, on pace for its best day since May 2022.
I'm still stuck on Ralph Lauren. Those are some crazy numbers.
They really are. Right?
Yeah, geez Louise. It feels like...
Do you tend to buy Ralph?
Not really. I just wear leggings all day. But it almost feels like another Abercrombie, another retailer that is just popping off right now.
And especially what that's a tell on the economy, if shoppers are still willing to go spend money at the more expensive type of brands.
That's true. You can't paint with a broad brush here. There's a lot of idiosyncratic stories. Jess Menton, great stuff as always. That is our equities reporter, Jess Menton. Now coming up, shares of engine maker Cummins are also on the rise this week. We'll speak to the company's CEO and chair, Jennifer Rumsey, up next. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Whatever this number looks like, we will build a massive narrative and extrapolate it out 12 months.
Yep, and then we'll remind ourselves that these are very noisy numbers.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
How tight can the labor market get if we do see these deportations?
Companies are waiting to figure out what the policies are.
And lots to think about.
The January Jobs Report, Friday on Bloomberg.
Now to high interest, a look at what's making headlines around the world. Google is the latest company announcing changes to its diversity hiring plans. According to an internal memo, it said it's reviewing its programs and would no longer have, quote, aspirational goals tied to representation. It joins Meta and Amazon in big tech's retreat from DEI initiatives, which have been rejected by President Trump's administration. Chinese retailers selling goods on popular platforms Temu and Shein have been slapped with a 30% levy. The vendors received the news about the new prices last night. The added stress comes as the US Postal Service flip-flops on inbound international packages from China and Hong Kong. Warner Music Group and the streaming music giant Spotify unveiling a new multi-year collaboration today. The companies will work together to provide a deeper music and video catalog. The agreement will also expand paid subscription tiers and introduce new content bundles. Financial terms of the deal were not disclosed. Katie.
All right, let's switch gears here now to Cummins, because President Trump's tariff threats loom large over manufacturers who source at least some of their raw materials and components from international suppliers. Here to talk more about the potential impact, I'm pleased to say we're joined by Jennifer Rumsey. She is the CEO of Cummins, which of course is a global engine maker. Great to have you with us. Obviously, the top concern probably for investors right now is tariffs. So if you could give us an idea of what Cummins' exposure to Mexico and Canada looks like and what steps you're taking to maybe diversify that supply chain would definitely be interesting.
Hi, Katie. Great to be back with you. Let me just start. We announced our Q4 and 2024 results earlier this week. And so I just want to start by thanking our 70,000 employees around the world for delivering record revenue and profitability for Cummins. And, you know, our products are performing really well in our global markets. We're really pleased with how we're doing. And despite some softening in one of our historically most critical markets, North America heavy-duty truck, we saw growth globally and really strong demand in markets, most notably our power generation market. And our strategy really is about making products in the markets where we're selling to our customers. So our engines and gensets that we're selling here in the U.S., we're making here in the U.S. As you noted, we do have material and some of our components that come from outside the U.S. and Mexico, most notably. So while we're well positioned with our product manufacturing footprint, you know, we are concerned about blanket tariffs and potential retaliatory action that might happen in these U.S. and Mexico tariffs, and want to make sure that U.S. companies are competitive internationally and that we don't drive inflation into the U.S. while also focusing on creating a strong U.S. economy and jobs here.
Given your dependence on Mexico, then, Jennifer, have you done anything yet to diversify your supply chain geographically, let's say, or, you know, do anything because of the back and forth?
Yeah, so Cummins is a global company. As I said, we're making in markets around the world. We leverage the scale position that we have. I think every company in recent years has really been focused on supply chain resiliency because of the disruption and the geopolitical world that we're living in. That said, when you're a large-scale manufacturer, it takes multiple years to make some of these shifts, and we need to be able to stay competitive globally, leverage that global scale. And so having stability and clarity on what's going to evolve is really important for Cummins, for our customers, and on our industry.
Well, Jennifer, and I promise we'll move on, but are you taking any pricing actions or thinking about any pricing actions that you could take around the possibility of tariffs? We were talking about this earlier with one of our autos reporters that even if these tariffs are being used as a negotiating tactic, I mean, you have to manage a business around that possibility.
Yeah, certainly we have to manage our business while we would work to offset any impact. If we do see sustained tariffs, we'd have to pass those costs on to our customers, which is why the concern about inflation and the impact on the U.S. economy.
So difficult to foresee and forecast. What about regulations, Jennifer? There's supposed to be new heavy truck emissions regulations coming in, and also additional greenhouse gas rules coming in, all by 2032, 2027 in the former case. Do you anticipate any of those might get rolled back, and is that impacting any decisions you're making right now?
So Cummins has a long history of actually embracing change, including change driven by regulation, as a way to innovate and grow our business. And we think it's really important that we invest to meet our evolving customer needs. And we're continuing to do that and invest at record levels. And so part of that is our strategy we call Destination Zero, which is focused on decarbonizing. Now, our approach is to invest in a range of products. We understand the transition will be long, will be messy, and we're really evaluating when we bring new products to market based on how things are evolving, regulation, infrastructure, incentives that help customers start to adopt this. The nearer term regulations that we're facing here in the US, which go into place in 27, we believe will largely stay intact, but that we will be looking at evaluating CO2 regulation, and there are concerns about affordability and infrastructure around those. And as we have always done, we embrace the need for change, meet our customer needs, and work with regulators proactively to help them understand the issues, the opportunities, and how to make appropriately clear standards that our industry can invest over multiple years to meet.
So we'll definitely keep an eye on that one. I do want to talk a little bit about some of your end markets, of course. Like we said, Cummins, obviously a major engine maker. What are you seeing when it comes to demand for trucks, the transportation industry overall? And are you seeing any signs of weakness potentially?
I mean, overall, I'd say the products that we have out in the field are performing really well, and the customer pull for those products is very good. We have seen some softening in the U.S. heavy-duty on-highway market, really in the second half of 24. That market for us and our truck customers held up pretty well because of the large back order that was built up through the supply chain challenges that we faced a few years ago. But we've seen some softening. We think first half for our on-highway markets is going to continue to be softer, and we're prepared for that, and then for that to strengthen as we go into the second half of the year. But our power generation business, which is impacting both our power systems business as well as our distribution business, remains very strong. This demand for data center backup power, which we're very well positioned to provide with our products, continues to grow, and we're investing in capacity and new products for that market.
So it doesn't sound like you're seeing any signs of demand plateauing there. What about China, Jennifer? Have we seen the trough in China?
Yeah, our outlook for China for this year is to be slightly up. It's been a weak market over the last couple of years. There has been some stimulus that's gone into that. And so we believe that as we come back from the Chinese New Year there, that we may see some uptick in the on-highway market in China. And then, like we see in the U.S., really strong demand for our power generation products.
All right, Jennifer, that's a good place to leave it. Great to get some time with you. That is Cummins CEO Jennifer Rumsey. Now, still ahead, a Waffle House egg surcharge is ruffling a lot of feathers. We'll have the details next. This is Bloomberg. All right, it's time now for Social Climbers, the companies making waves this morning. And first up, we have Hershey's projecting a sales increase this year despite higher commodity prices. Hershey, of course, has been faced with record high cocoa costs for over a year, forcing price increases. Shares currently up about 4.7%. Next up, we have Starbucks placing some limits on its mobile orders in an effort to reduce the workload of baristas. It's part of a broader plan by CEO Brian Niccol to speed up the service. The coffee giant also trimming about 30% of its menu. We'll see when that starts to pay off. And finally, let's talk about the 24/7 dining chain Waffle House is adding a 50-cent per egg surcharge to the menu as the bird flu outbreak causes prices to skyrocket. The Agriculture Department predicts that egg prices will soar another 20% this year. You think about Waffle House and you think about getting an omelet or something at Waffle House, how do they count the eggs? Because you sort of just put it all together. I'm pretty sure they have a big gallon of eggs that they just pour out.
It's a great point. They must have an egg cracker and, you know, those egg bird sorters in the back. But did you hear about the 100,000 egg heist that just happened in Pennsylvania?
That did not come across my radar.
Panic buying in Pennsylvania and across, you know, the country as bird flu really does get rid of more and more roosters and hens and all of these birds that have the ability to lay eggs. Actually, it must be hens, right? The hens lay the eggs. Anyway, I guess there's been this, you know, this heist in Philadelphia where 100,000 eggs have gone missing. But I mean, they need refrigeration, so
that's the thing. It's not shelf stable. So even if you steal the eggs, you have to have some plan for how to store them. But.
Exactly. You would think that the authorities would be trying to crack the case.
Crack the case. Oh. Jeez Louise. Just terrible.
That was terrible.
Yeah. Eggs a hot commodity, though. They're, I don't know, precious. Anyway, let's get a check on these markets. You can see we're a little bit higher today, but we have a great conversation coming up with the CEO of LabCorp next. This is Bloomberg. Well, lab services giant LabCorp reporting strong earnings earlier today as diagnostic testing demand ramps up. LabCorp CEO Adam Schechter joins us now. Adam, great to have you with us. Let's just set the scene here, because we think about your business. You have traditional diagnostics, and then you also have biopharma services. So just give us a quick overview of what the outlook is in those two markets.
Absolutely. Katie, it's a pleasure to be here with you today. So we reported our fourth quarter results today, and we also reported guidance for 2025. And as you said, we have two parts to our business. We have our diagnostic testing business, which is the largest part of our business. And then we have biopharma laboratory services, of which there's two parts. There's a central laboratory global business, and then there's an early development research laboratory global business. As we looked at the fourth quarter results, each of those businesses grew at least 10%. Diagnostic revenue grew 10.2%. Central laboratory revenue grew almost 10%. And if you look at our early development business, it grew 12%. As then take it into 2025, the guidance that we provided shows overall growth across LabCorp, across the segments, of 7.5% for revenue. And then we also gave, that's at the midpoint, we also gave a midpoint for EPS, which would represent 10% growth. So a very strong profile looking at 25.
Yeah, many acquisitions this year. In fact, Adam, you also acquired assets from Invitae to bolster capabilities in genetic testing. Just curious as to whether you could talk about what specifically you're going to have to do in order to drive profitability in that business. What will you have to do between the first half and the second half?
Yeah, so if you look at our diagnostic business, we showed tremendous growth. About half of the growth came from organic growth. The other half of the 10% came from inorganic growth, came from acquisitions. We did 10 acquisitions in 2024. Many of those were hospital or local regional laboratory acquisitions where we acquired the labs or the outpatient services. But we also did acquire a company called Invitae, which does genetic testing. If you look at Invitae, the revenue grows very well, but it wasn't very profitable. It wasn't frankly profitable at all when we acquired it. Bringing that into LabCorp, we'll be able to make it profitable. We expect the revenue for Invitae to grow at 10% per year, and we expect it to be accretive to earnings in 2025. If I look overall at the strategy, though, that's what's most important. Strategically, there's four areas that we're really focused on: oncology, women's health, autoimmune disease, and neurology. Each of those four areas, there's huge medical unmet needs. There's a lot of advances in biology and science, and we feel like we can make a significant difference there. Invitae is very strong in genetics, but also in oncology and women's health. So we think that it really adds to our strategy and our focus.
So it's interesting. I mean, you're talking about the 10 acquisitions that you completed in 2024. I take a look at your closest peer here, Quest. They also have been pretty acquisitive as well. And just from an industry-wide perspective, I mean, what is driving that sort of activity, and how much more runway basically do you think there is?
You know, it's interesting, if you look at LabCorp and you look at our market share in the market, it's still very small. It's only about 10%. And if you put the two largest laboratories together, they still represent a very small fraction of the overall diagnostic market. Hospital systems represent a very large part of that market. I think after COVID, hospitals realized that running their laboratory takes a lot of capital, a lot of expertise, and that we could probably do it better than they could. I think that's what's led to a lot of hospitals wanting to do partnerships or deals with us.
And Adam, I also want to talk about bird flu. We were just talking about it through the lens of egg prices, which have just been off the charts. As I understand it, you introduced a bird flu test recently. You worked with the CDC to do that. Just give us some color there around what that would mean for your business, and what the demand looks like for that test.
Yeah, sure. Now, we have a very broad range of tests. We have over 6,500 tests available on our testing menu. If you look at things like flu, COVID, RSV, add bird flu to it now, those are typically seasonal. We don't think of any one test as an area of great growth opportunity. We look at the portfolio of tests and being the lab that can provide whatever the physician is looking for that patient as the reason that we're so successful. As I look at bird flu, it's not a significant amount of our tests as we speak, but we're prepared just in case we need to be for the future.
Yeah, we'll certainly see how that one develops. And I am curious, I mean, when it comes to your business, like you said, it's all about the portfolio. What does the decision-making process look like when it comes to adding a capability, when it comes to adding a type of test? Are you looking at, number of cases, or just take us into that process?
Yeah, so we typically bring to market between 85 and 100 new tests every single year. And we look for medical unmet needs. We look for where we can add the most scientific value. Typically, if there's a medical unmet need, therefore the test will be utilized over time. So it really starts with science and technology, and the profitability, frankly, follows.
All right. Adam, thank you so much, and congratulations on another quarter and on the Raritan, New Jersey expansion. That is LabCorp CEO Adam Schechter. Let's get a look now at stocks moving at this hour with Bloomberg's Jess Menton. And Jess, I just noticed it a little time back, Yum Brands crossing the wire. Tell us what they said.
And so this is the company that owns Pizza Hut and KFC, but in particular, it was Taco Bell that was helping drive sales in the latest quarter. And it's interesting, too, because when you're looking at this, that stock's actually just a little over 1% from its all-time high that it last reached in April of last year. So that's why it's important to keep an eye on. It's up about 8% today, on pace for its best day since April of 2020. So looking at those sales turning positive, and also this is an inflation story, because when you think about recent quarters, especially at the start of last year, it still was feeling that inflation print when you're thinking about the pressure, especially consumers and shoppers and people going to eat at a lot of these restaurants. So that also is a more positive sign for this type of company moving forward.
Yeah, really interesting to see the stock popping about 8% today. Let's also talk about Philip Morris hitting a record, I believe.
It is.
The kids love Zyn. What's going on?
They definitely do. So the Zyn that you're pointing out, that's the patch, the nicotine patch. And that's what's driving things too. So I want to point this out too, because the consumer staples sector that obviously Philip Morris is housed in, that's the best performing sector today. It's up about 0.7%. So helping it give a lift, even though we're seeing some other pockets of consumer staples lower today. So as to your point, it is the smokeless tobacco products that were driving its gains today.
And of course, then there's Honeywell, and it was kind of that 1-2 punch, right? So they finally sort of made it clear that they were actually splitting up and into 3 portions, not 2. But then those earnings caused the stock to drop.
It was, especially when you're thinking about its guidance falling short of that estimate. But of course, now that Elliott Investment Management, they were basically pressuring in recent months, especially in November, because at that point, that's when Elliott revealed a $5 billion plus position in Honeywell. And that was actually its largest ever in a single stock. So you are seeing Honeywell, the ticker symbol is HON, down more than 5% on pace for its worst day since July 2023. So when you're thinking about its aerospace division, what's happening with its advanced materials arm, as well as when you're thinking about what's happening with its automation business, that's what the key driver is here. And especially because when you have that activist investors pushing it, they're hoping that potentially there could be more, especially when you're thinking about what shareholders are pressuring and want from that. But it obviously remains to be seen what this could mean for this type of stock moving forward.
Yeah, it definitely will be fun to follow. Jess, great stuff as always. That is Bloomberg's Jess Menton. Now coming up, forget the Fed. The administration wants to focus on 10-year yields and bringing down borrowing costs. Wall Street Week's David Weston gets insight on the U.S. debt problem with Bridgewater's Ray Dalio next. This is Bloomberg. Well, it's time now for our daily Wall Street Week conversation. And how do you solve a problem like America's ballooning debt? Treasury Secretary Scott Bessent says that the answer may lie in 10-year Treasury yields. Bloomberg Wall Street Week host David Westin sat down with Bridgewater Associates founder Ray Dalio to talk about the problem.
Bridgewater founder Ray Dalio has written a new book, available at no charge online, addressing the U.S. debt problem. It's called How Countries Go Broke. And he starts with how much the U.S. is going to have to borrow and who will lend it the money it needs.
The difference is they can print money. And then that's basically it. So what you have is a situation where there's a supply and a demand for debt. As we have a new supply, that will equal in the United States now, by the way, this is a problem elsewhere too, but it's about 7.5% of GDP. So the supply of debt is going to be large. That's new debt. If I calculate also who are the buyers of that debt, and that there's not going to be enough demand for that debt. It doesn't look like there'll be enough demand. And the way that it works, so there's two things to keep in mind. There's supply and demand, and then what do central banks do, or what do the governments do when they don't have enough demand? Central banks come in and make up that demand. They essentially print money, and then they buy that. And then that has a consequence. And so just like in 2020, 21, we went through, they needed to give money away, and the government needed to borrow, and the central bank produced the money and bought that. That devalues money, raises inflation, and so on.
Thus far, the United States has been able to support ever-growing debt and deficits because of that ability to print money. But Dalio warns that, throughout history, countries have run up against the demand of creditors sooner or later to get paid.
It is when the owners of that debt, we have, over $36 trillion essentially of government debt, when they start to also fear that it may be monetized, like the Japanese. Japanese is a very good example. Japanese, if you have terrible investment to own bonds, they didn't go down in value, but you got an interest rate that was 3% below another interest rate, U.S. interest rate by example, and the currency depreciated by 3.5%. They were losing 6.5% a year for many, many years. That's what it can be like. Of course, there's an inflation component that enters into the depreciation. One of the things I also want to emphasize is people pay too much attention to depreciation against another exchange rate. Normally at such times, many countries have this issue, and they don't want their currency to depreciate. So what you see is the depreciation of all currencies in relationship to things like gold or other assets, and that's where you have to pay attention to it.
And that, of course, is Ray Dalio speaking with David Westin, who joins us now. And David, a really interesting and timely conversation on the deficit, especially when you layer on what we heard from Scott Bessent yesterday. We'll hear from him again today on Bloomberg Television.
And Ray, I think his book is quite timely, given the discussion we're having right now in Washington. Scott Bessent's talking about what we're going to do with the debt and deficit, because most people think we can't keep going. Scott Bessent has said he talks to Donald Trump regularly, and Donald Trump is concerned about it. And to some extent, they overlap, Scott Bessent and Ray Dalio, on what needs to be done, because in his book, Ray Dalio says we have to do whatever it takes to get our annual deficit down to 3% of GDP, which is a 3% number, as you know, that Scott Bessent adopts as well. Mm-hmm. They have somewhat different ways of getting there as a practical matter, but they basically agree on that core goal.
So right now, the deficit is about 7% of GDP, which is obviously double, more than double of what they would like. At the same time, it's not out of control, and it is the United States of America. Do we really need to worry about the deficit? Do we really need to worry, as Ray Dalio says, that we'll run out of buyers?
Well, you have to understand his analysis. It's the way he looks at things. As you know, he looks over long periods of time at macroeconomics, and he says there are long debt cycles. This one started in 1945, he says, and as he looks around the world over hundreds of years, sooner or later, you do have to produce too much cash, too much currency, and it depreciates it, and something has to happen, and there has to be a break. And he thinks actually we're getting close to that point if we don't take some pretty substantial action. As I say, Scott Bessent agrees with him on that point.
Yeah, well, so they agree there, but talk to us about the different approaches they would take to get to that 3% level.
Well, Scott has his 3-3-3 approach. He wants 3% growth, 3% more oil production, and he wants 3% of GDP deficit. Scott thinks we can get there through cutting costs, really cutting some spending from the government, as well as demand supply stimulation. Ray says, I don't care how you get there, but you're going to have to raise taxes as a practical matter. That's something Scott Bessent does not think we ought to do. He does, Ray, focus on the interest rate, because you have to understand we're making it worse as the interest rates go up, because that means we have to pay more money on the debt that's outstanding, and sort of a vicious cycle. You got to get that interest rate down in order to not pay as much in interest. And that's, I think, what Scott was saying yesterday, the Treasury was saying, we have to really focus on the yield on the 10-year.
So I suppose if there's anywhere where they agree, that's where it is, right, David? But it's not as easy done as it is said.
Well, and Ray, in his book, he goes through a lot of analyses, as Ray tends to do. He goes through cutting government spending to get down to a 3% annual GDP deficit is going to be just about impossible. I mean, he thinks in order to get to that number, for example, if you wanted to divvy it up, it would be 4% cut in spending and a 4% increase in tax receipts in order to get there. They have to do both of those things together. And if you take away the tax receipts, that means you really have to cut government spending rather dramatically.
And before we let you go, David, I do want to talk a little bit about the Treasury refunding announcement that we got yesterday, because Scott Bessent had been critical of the way that Janet Yellen sort of set up these debt sales, but largely stuck to what she's been doing.
At least for now.
Yeah.
I mean, I read that as well, and I was curious about that, because Bessent had been saying, goodness gracious, she really has been loading up on short term and really not buying long term in order to keep that yield down. By the way, Larry Summers has been saying that on our program, Wall Street Week, for years now, saying, why didn't they take on long-term debt at low interest rates? But I think most people thought, even if Scott Bessent wants to get to a different balance in the term, he can't do it right away. It would cause such shocks that it's going to have to happen over time. So we'll see over time whether they start making adjustments in the long end versus the short end.
Yeah, investors already have a lot on their plate. Maybe we'll wait when it comes to terming out the debt. But David, great stuff as always. That is David Weston. And Treasury Secretary Scott Bessent sits down for a live interview with Bloomberg's Saleha Mohsen at 1 p.m. Eastern. So that's today. And then on Friday, you can catch Wall Street Week at 6 p.m. This is Bloomberg.
Senate Republicans are breaking with the House over budget legislation to carry out President Trump's agenda. The newly announced plan would delay action on tax cuts until a second budget reconciliation package is passed. The president is meeting with Republican lawmakers shortly to discuss a resolution. Joining us now is Balance of Power co-host Kayleigh Lines. So Kayleigh, what will he say to Republicans this time round in order to perhaps sway some minds that he wasn't able to say up to now?
Well, Vonnie, it's going to be a question of whether President Trump actually takes a firmer stance on how procedurally he would like Congress to proceed with his legislative agenda. Because while he has expressed support for what he has described as one big, beautiful bill, the idea that you do everything he wants to achieve from the border to energy to tax policy, all in one big reconciliation package, he has suggested on multiple occasions that really he's open to either as long as it all gets done. So will the president put his foot down specifically when it comes to hardline conservatives in the House, who are really the ones who are delaying this process, if you will, demanding larger spending cuts, which is what has stalled a budget resolution, which is the first step in this process. And that is why, because of the difficulty in the House, the Senate looks like it may try to move first here. As you alluded to, Vonnie, Lindsey Graham, who chairs the Budget Committee in the Senate, is out with a new plan that would be about $300 billion in spending, focused on things like the border and defense, energy as well, punting tax policy discussions until later. But we had the chair of the House Ways and Means Committee, Jason Smith, on Bloomberg Surveillance yesterday, and he maintains that if the Republicans want to get all of their objectives on tax policy done, they need to do it in one big bill where there's incentives for lawmakers to agree to other things because of things they may like on the border and that kind of thing, that it's just really difficult to get multiple budget reconciliations through the House in just 1 year period. So we'll see if they come out of the White House with more clarity here. It is going to be Republican leadership in the House as well as others, and we may very well see them as they emerge from the cabinet room in the West Wing, going to the sticks, as you will, to answer questions for reporters and get some clarity on the path forward.
Well, Kayleigh, how much, leverage and time does the president have to give to this?
Well, timing is the interesting part of this, Vonnie, because he obviously has come out of the gate trying to use all of his executive power to achieve as much as possible through things like executive orders. The legislative part of this, with tax policy, getting more money for his border objectives, is really what he needs Congress for. And if he wants to be able to achieve this all within the first 100 days, that is where the clock really is ticking. The timeline that was outlined by Speaker Mike Johnson was that the budget resolution markup in the House would happen this week. It does not look like that is going to be the case, because he wanted to be able to get things passed by the end of February, with the ultimate objective of having reconciliation through the House before the Easter holiday in April. That timeline looks like it is being slowed down materially, though. It's unclear whether President Trump will be satisfied with that, as he really wants to have early wins here. And that is where he may find himself, or Senate Republicans may find themselves, trying to convince him that he could get early wins on things like the border by separating these things out and doing one reconciliation package before the other.
So we'll see how that shakes out. But Kayleigh, I want to switch gears and talk a little bit about Treasury and Doge and what that political football looks like. The latest reporting we have is that Treasury access by Doge was partially limited by a judge for now. What do we know?
Yeah, this is a district judge here in Washington, Katie, essentially has pulled back on the ability for those close to Elon Musk, two individuals, to share information about the Treasury payment system or gleaned from it with others. Two others close to Elon Musk will still have access. But this is essentially not a resolution to the lawsuit that was brought on behalf of unions like the AFL-CIO, who suggest that Elon Musk having access is illegal because he can see things like government employees' social security numbers. The judge is still going to be hearing arguments about this later, which will get us to a firmer resolution. But this is essentially as a bridge, as we have seen a lot of uproar over this access. And of course, the Treasury Secretary, Scott Bessent, has said that this is read-only access, that they aren't actually able to disrupt the payments that Treasury is making or have control of that in any way. But that hasn't been enough to assuage a lot of concern on the part of federal employees or the unions representing them. And of course, Democrats, who have had strong words for Elon Musk and everything he's trying to do at the Department of Government Efficiency, including, of course, efforts to slim down the federal government. And there is a deadline of midnight tonight for federal workforce employees to take a buyout offer that would see them paid, in theory, through the end of September if they voluntarily leave by the end of this month.
Right. I think we've seen 40,000 so far. It'll be fascinating to see what the final number is. Balance of Power co-host Kayleigh Lines joining us from Washington. Really appreciate the time. Meanwhile, a quick check on these markets. A slight rally underway. Slight gains on the S&P 500, on the NASDAQ 100. Your 10-year Treasury yield currently about 1 basis point higher. Not too much going on on there. Really looking forward to that interview with Scott Bessent coming up, because we know he's watching it.
That's going to be a market-moving interview for sure. Also, of course, Amazon earnings out after the close. They absolutely will be market-moving as well.
Absolutely. Sentiment in the stock market at a really interesting place, so we'll see.
Eco data tomorrow.
That's true. Big jobs day coming up. And to that point, we have a great lineup for Jobs Day. Coming up tomorrow, we'll be joined by Rick Reeder of BlackRock, Julia Coronado of Macro Policy Perspectives, plus from the C-suite, Elf Beauty CFO Mandy Fields, as well as FICO CEO Will Lansing. We'll see you tomorrow. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Jackie Davalos in San Francisco. This is Bloomberg Technology.
Coming up, ARM shares are down after a conservative forecast. We get the CEO's take on the strength of smartphone and AI demand. Plus, Roblox shares slump after users and engagement slide. We dissect the worst sell-off since May. And the CEO of Vanguard joins to discuss the company's record fee cuts for dozens of mutual funds and ETFs. But first, we look at these broader markets right now. We're wobbling around gains and losses on the Nasdaq 100 more broadly. Muted muted. We're up just about 0.1%. There are some big moves when you look underneath the hood. NVIDIA on a points upside here. On the downside, we're a little bit anxious about Tesla. We'll get into that later. But move on to see what the individual movers are from an earnings perspective. Qualcomm off by 4.8%, one of the biggest points drags to the downside. Look, they managed to beat in terms of earnings. They beat in terms of forecast. But the outlook for the smartphone market is where it dulls into investor anxiety. Are we flatlining, only seeing flat to single-digit growth there? That, of course, smartphone anxiety does feed in a little bit to ARM Holdings as well. Key chip designer out there, of course, down some 4%. Look, they too beat the street on earnings per share basis. You look at revenue dialing up almost 20%. But again, it's about a conservative forecast and what this means not only for smartphones, but what it means for AI demand as well. We've got to get to it with ARM's CEO, Rene Haas, who joins us now. And I put it to you, you've been out everywhere at the moment. There's deals being done, of course, with SoftBank and OpenAI that we'll dig into. But what about this forecast and what it signals for your business? Is it just you being conservative as a newly public company?
Thanks, Caroline, and appreciate you having me on this morning. Yeah, I don't know if I agree with the dialogue muted forecast. We beat our projections for Q3, and we actually raised guidance for Q4 and for the year. And we're looking at about $4 billion of annual revenue, which is about 25% increase over the last year. So we're super happy with the trajectory of the business and super happy with the performance.
Maybe just investors are too exuberant. They're too exuberant around the fact that you've already said your compute platform is going to help OpenAI and SoftBank make good on their advanced enterprise AI. The optimism around your AI future as well as how integral you are to smartphones. So is it that? Are people too excited about the AI opportunity here?
You know, I'm going to try to decouple what the market is saying about our results and just talk about the results in general, of which we are, again, incredibly pleased by. We are seeing extremely strong demand for our products across the board. We had record royalties. We were up 23% year on year. Our version 9 compute subsystems, which drive higher royalty rates, we're just growing faster than the market, which is what we told investors when we went public back in Analyst Day a year and a half ago plus. So, yeah, we're not seeing any slowdown in demand, quite frankly, Caroline. In fact, we're seeing an acceleration in it, particularly driven by all things around artificial intelligence.
Rene, speaking of future growth, one of the things that ARM is also banking on is its high-profile partnership in Stargate, and you're a big player in that. Could you kind of tell us what investors can expect this year to gain from that venture?
I can say, broadly speaking, the way to think about Stargate is it's an infrastructure project unlike any other. $500 billion, $100 billion was spent initially, and these are to build out the world's largest AI data centers for training and inference. We are the key technology partner around CPU. We're the only CPU technology partner that was named, which is terrific, obviously, for us. One can imagine going forward a lot of opportunity for technology innovation there. But in the near term, we'll be linked with the Grace Blackwell chip using the Grace CPU, which is ARM-based, and the Blackwell GPU, which is NVIDIA-based. But these large frontier models are going to require, Jackie, a huge amount of power for training and inference. And we're just so excited about being involved in this. It's going to be fantastic.
Well, at the same time, this project also kind of puts you in the middle of this U.S.-China tech rivalry. You're at the front lines of it, being the top supplier to American AI companies. And I'm curious if you think that perhaps tying your fortunes so closely to OpenAI is a risk.
I'm not sure I think about it quite that way. OpenAI is a fantastic partner. Arguably, they're the leader at the moment in terms of adoption of ChatGPT and their APIs and their enterprise suite. We work with everyone, though. We work very closely with Google. We work closely with Meta, AWS, all the partners. But we're very thrilled to be involved with OpenAI. They have phenomenal technology.
Rene, we're going to lean into that China-US story. DeepSeek, extraordinary, the push and pull it has in the narratives. Can you explain as to whether you think we are going to need as much compute as we all foresaw before?
Oh, I think unquestionably, Caroline. And in fact, I think even more than we probably have been thought about. So why is that? Well, if you look at what DeepSeek has done, which is an amazing, by the way, piece of work, they've done what's called distillation. And distillation is building on top of an existing frontier model, which takes lots of power and lots of compute to generate. If you think about GPT-4, which was hundreds of megawatts, GPT-5, 6, 7, these are in the gigawatts. So even though you may have models that can distill or build upon the frontier models still need a lot of power. And then with that drives a huge demand for inference, which is really where the larger use loads are. And more efficient inference means you can drive AI to much smaller devices, to smartphones, earbuds, devices that don't have a lot of capability for power. It's great for ARM because that's where we are today, it's where we exist, and now you can run those AI workloads on the CPU. So I think actually that what DeepSeek proves is that we're just going to see an even more accelerant towards compute.
Well, on that front, you have a significant business in China. Are you concerned at all about perhaps how the slowing smartphone business might affect ARM's future growth?
Yeah, it's a great question. And, again, what we've seen in smartphones, which are at single digits type of growth, we're in the double digits growth in terms of royalties, in some cases 20% growth. And why is that? We're putting more technology into these phones. Our version 9, our compute subsystems drive higher royalty rates. So we're just growing faster than the market, and particularly in the premium segment, which requires more and more compute. So while the units have been slowed in some areas, it actually hasn't impacted us very much. Just look at our record royalties. To have this kind of number in a market where people think things are slowing down, just phenomenal.
Record royalties, upside in licensing. I would just want to get to the litigation, if I may, Renee, and briefly. Perhaps it hasn't gone the way that you thought with Qualcomm. What does it mean for the future earnings?
Really, there's no impact on future earnings, Caroline. The trial was a mistrial on one of the verdicts, so the dispute is still open. But to your question in terms of future forecasts, no impact whatsoever.
Renee Haas, CEO of ARM, thank you for joining us. Coming up, more with tech earnings with Ayako Yoshioka from Wealth Enhancement Group. Caroline?
Let's have a quick check on some other earnings that we've had on deck. Peloton is one of them. Look, I'm afraid revenue is down, but profitability is better. A new management team managed to lift the optimism around this name. We're at 14% higher, but it's only trading at $8.68. From New York and San Francisco, this is Bloomberg Technology.
back to earnings with Roblox out this morning and reporting daily active users for the fourth quarter that fell short of estimates. Let's bring in Bloomberg's Cecilia D'Anastasio to break down the numbers. Cecilia, break it down for us. What went wrong here that ultimately spooked investors?
After many quarters of growth in daily active users, Roblox unfortunately reported a disappointing decline in how many people are accessing the platform in the last quarter. And in an earnings call today, Roblox's chief financial officer partially attributed that decline to Roblox's ban in Turkey over concerns over child safety.
And what's interesting is child safety affecting Turkey, of course, the key country here. But it wasn't long ago that Hindenburg Research accused Roblox of also inflating user numbers and time played. Is there any hint at that read across in these numbers, Cecilia?
Lots of analysts have cast doubt on those allegations against Roblox's user number inflation. Unfortunately, I don't have anything original to report on that currently. But Roblox's growth has been pretty consistent for a long time. People are very disappointed by these results.
Cecilia, what's competition looking like in this space?
Sure. So right now, growth in the games industry broadly is very challenged. The cost of developing AAA games, your Spider-Mans, your Overwatches, is skyrocketing. And at the same time, a lot of investors are seeing potential in user-generated games like the ones that people create on Roblox. These games are often created by amateurs or by very small teams using tools that the companies themselves provide. Epic Games, which makes Fortnite, has its own platform along these lines as well.
And some of them get sold for an awful lot of money. Cecilia D'Anastasio, it's great to have you. Thank you for running us through Roblox. Let's get more earnings takeaways with Ayako Yoshioka, who's with us, portfolio manager at the Wealth Enhancement Group. And there's been so much to digest. One theme that seems to be running through is AI anxiety and smartphone anxiety. And I just want to bring up with what we're seeing with Qualcomm and ARM today, and a worry about smartphones flatlining and what that means for some of these chip providers. What do you make of it, Ayako? I know you don't hold Qualcomm or ARM, but what would you make about the read across?
Sure. So, hi, Caroline. In terms of the overall AI environment, I think we're focused on both the short term and the long term, right? In the short term, for companies like Qualcomm, they're really impacted by the handset slowdown. However, I think if you look out longer term, and where they're going to play is really in that, inference side, or, where the chips will be able to be in smaller devices, as the ARM CEO talked about, and things like new form factors with like Meta's Ray-Ban glasses. These are going to be where Qualcomm might have additional exposure to, which would be a positive for Qualcomm.
It's interesting. The best points contributor on the day is Nvidia, and there's a note out of JP Morgan saying actually, like these DeepSeek moves, this less compute necessary is actually going to win out for them from an inference perspective. So where have you come out on this whole divide as to whether companies should be spending a lot on AI infrastructure?
So I think the arms race is on, and that most companies are going to spend in order to make sure that they have all the primary models set, all the frontier models that ARM talked about. And then it's going to be how best to access, all the efficiencies that DeepSeek brought are going to be, explored by many companies. And so I think there's a lot of ways to play AI, and, we're still trying to figure out what the landscape is really going to look like, and it's accelerating. It's just moving so quickly. Every month there's something new.
On the cloud computing front, we've already seen some mixed numbers coming from the hyperscalers, Alphabet, Microsoft. What are you expecting when Amazon reports later today?
Sure. So I think everybody's focused again on what the CapEx guide might be, any sort of color commentary on CapEx. Everybody's looking at that CapEx trajectory to see, is everybody getting that return on that spend? But, I think the demand for cloud computing continues to increase. And so it makes sense from a long-term perspective for many of these hyperscalers to continue to spend on increasing capacity in the cloud.
Speaking of demand, one of the things that always surprised me about Alphabet's cloud unit is that it had a good chunk of business coming from smaller, more nimble AI startups. And with some of the numbers that it put out, I'm curious if you are thinking if that kind of demand, if that vector of growth has kind of run its course.
I don't think so. I think AI is still so relatively new that I think there's going to be new innovative players that are going to want to access, that AI platform through Google or through Microsoft or AWS. I think, there's going to be different companies that explore different platforms just to see what's best for them.
What's so interesting is Amazon has been making its own chips. And so too, Alphabet actually, even though its shares fell on its earnings, Broadcom soared because of the CapEx spending and what it means for chip makers for some of these cloud computing companies. What do you make of how they're getting into the vertically AI focus?
In terms of the overall spend, I think it's just going to continue, that spend going to a lot of these chip makers. So whether it's NVIDIA or Broadcom, eventually it will come to Qualcomm as well. But I think it's going to continue. There's so many ways to access AI and build it out. I think it's going to continue to develop over the long term.
The thing that everyone's trying to wrestle with is the valuations. Though, with all this optimism, ARM trades at 100 times future earnings. Maybe that's why it pulls back from the day on what the market says is slightly muted forecasts. What do you make of the valuation levels since the sell-off from DeepSeek on NVIDIA, for example?
Well, and I think that's why Qualcomm's valuation is pretty interesting here. It's still in the, mid-teens, low double digits. And, I think that if you look out far enough, you'll see that there's potentially, a lot more growth coming for Qualcomm in the future. However, you have to look at the valuations both in the near term. NVIDIA does trade at high valuations as well. But again, if the build out continues, if you're really going to need to continue to spend so much, both, Broadcom and NVIDIA, and probably, the earnings are going to grow and catch up with the multiple.
Ayako Yoshioka from the Wealth Enhancement Group. Thank you for joining us. Now coming up, the White House says Elon Musk will police his own conflicts of interest. More details on this next. This is Bloomberg.
Elon Musk, who of course leads President Trump's government cost-cutting efforts, will determine himself if there are conflicts of interest between his work reviewing federal spending and his overlapping empire of 6 companies. It's all according to the White House. Let's bring in Bloomberg News' reporter and co-host of the Elon Inc. podcast, Max Chafkin. So he's going to be his own policeman.
He's going to be his own policeman. And, you know, while this is news, because we've been wondering all along, what is the plan here? I mean, Musk has 6 companies. He is somebody who his empire is rife with conflicts of interest. So it was kind of interesting to see how the White House was going to handle this. And we're learning basically they're not going to handle it. They're going to let Elon use his judgment, which I think was the plan all along. And I think even listening to things that President Trump said when he was on the campaign trail made clear that part of the point here is the fact that Elon Musk has these conflicts of interest. You know, Trump talked all about Mars. That is a thing that would necessarily involve some of Elon Musk's companies. So yeah, we're sort of learning something that I think was pretty clear, but we didn't know for sure.
Max, I want to talk about the tech because Elon Musk has said that he wants to use AI to find cost savings, and he's already mining for Medicare and Medicaid data in search of fraud and abuse. Do we know if this is something he could use his own company, xAI, to do?
We don't know what software they're using. It would not surprise me at all if he was using some modified version of Grok or you know some software that he has developed or is that it, you know, is somehow associated with another one of his companies. Musk has done this all the time. We've seen, you know, SpaceX engineers shuttled into Twitter. We're seeing, you know, people from his business empire now attached in various ways to this Doge effort. So yes, and of course that raises you know, interesting questions. Where is this data being stored? Are they taking the proper precautions? We've definitely seen critics, including you know, employees, government employees, as well as some of their unions, raise questions about this. You know, saying basically, is Elon Musk taking enough care of our private data?
I wonder if investors are wondering whether they're taking enough care of his fiduciary responsibility to Tesla. It's currently down almost 10% on the beginning of the year. We're trading the lowest since December. And meanwhile, you've got BYD in China announcing that it's getting into autonomous vehicles potentially, and Tesla takes another hit.
Well, so you have 2 things that are definitely true. One is that Elon Musk for sure is distracted. I mean, you know, I understand that he has like an endless amount of attention span. He's able to be very good at video games while running 6 companies. But if you look, he has spent a ton of time in Washington. He's essentially been parked there in recent weeks. He's tweeting all day and all night about Doge. That said, so in that sense, you might say, wow, like he's really distracted. He's taking his eye off the ball. On the other hand, there are clear ways that his companies can benefit from this partnership. And I think most investors understand that. And if you turn back the clock on that stock chart to like the beginning of November, you'll see that the stock is still way up. So I think, yeah, some of the enthusiasm, some of the sense that, oh my God, this Trump trade is like a home run has worn off, although there are definitely still people who see this as beneficial to Musk and his companies.
That's Bloomberg's Max Chafkin. Thanks for joining us. Now, today's Tech In-Depth newsletter takes a look at 2 different approaches in Silicon Valley on defense and war in Europe. Bloomberg's Mark Bergen has more. Mark, how are these conversations different in defense tech between the U.S. and Europe?
Yeah, I mean, I was sort of jumping off. We saw a really interesting hire this week from Andreessen, their American Dynamism Fund, which is their tech defense fund. They hired Daniel Penny, who's perhaps most famous as he was involved in that choking incident in the subway. He was cleared of homicide, but kind of became this cause célèbre. And as far as I know, he's a Marine veteran, didn't have a track record as an investor, but clearly something that, you know, we saw Vice President J.D. Vance tweet about his excitement about this hire. It's a signal for that firm, which has been kind of really leading the vanguard of the name the fund American Dynamism, that they're leaning in on this new era of reforming the Pentagon, this proximity between the Pentagon and Silicon Valley. And in many ways, this is something that's very different than what's operated in the past, where Silicon Valley and venture capitalists didn't really think about global borders.
It's interesting. David Ulevich I interviewed a few weeks ago. Catherine Boyle also leading that over at A16Z, and they have been leaning into defense side. Anduril, for example, they're looking at nuclear, at security. What's interesting, though, is last time I saw it, A16Z was pulling out of London and its office space there. So what does that mean in terms of looking at bringing this across the Atlantic?
Yeah, so I mean, to be clear, they shut down their office, their first and only outside the U.S. That was a crypto investing arm. They still are making some investments in Europe. They have a big position in Mistral, the French AI company. As far as I know, though, they haven't made any investments on the defense side here, where you've seen others like General Catalyst, even Sequoia, we've reported, has been looking. General Catalyst has been fairly aggressive in defense in Europe. I mean, it's really interesting, right? Where Europe is in the middle of this war with Russia. You go to these events in Europe, you hear constantly about Russia and the need to defend itself. And then you have events in the US, and I think the focus has been shifted to China and Taiwan.
And meanwhile, Palantir's own sales internationally were lower and weakness in Europe. Mark Bergen, it's great to have you. Go read his Tech In-Depth newsletter. It's, of course, from Bloomberg's journalists around the world. You can subscribe at bloomberg.com/newsletters. Coming up, we're going to be joined by the Vanguard CEO on the company's record fee cuts. That's next. From New York and San Francisco, this is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Now, Vanguard has slashed the fees for dozens of its mutual funds and ETFs this week in a record move that sent a shockwave through the asset management industry. The reduction is the largest Vanguard has ever undertaken. For more now on the impact on BlackRock on Invesco, Bloomberg's Katie Greifeld is standing by for more. Katie.
We welcome now our TV and radio audiences worldwide. I'm pleased to say we're joined by Vanguard CEO Salim Ramji in an exclusive conversation. Salim, great to have you with us. So we all saw the ripple effects.
Great to be here, Katie.
Thank you. We saw the ripple effects from Monday's move, and your average fee now is just 7 basis points across your lineup. The industry average, for context, 44 basis points. Set the scene for us. Why now?
Well, you know, in one sense, I will say Monday was a pretty joyous day here at Vanguard. And it was joyous because it really is a reaffirmation of our business model. We're owned by our clients. And so as a result, as we gain scale economies here at the company, we share those back with our clients. And that's not just been true since Monday. It's been true since 1975, since when we founded the company. And so this was continuing on a 2,000 price cuts, I think, by our tally as of last week. Now it's 2,168 price cuts. And that's been part of the proposition that investors have had with Vanguard for decades.
And so, Salim, I think I'm asking on part of your competitors, but also investors as well, when I ask, how low can fees go? You're at 7 basis points right now. Where is the possible floor here?
Well, you know, we don't price products as loss leaders. We're not looking to, you know, price abnormally low in order to get somebody into a higher cost other service. And so we really look at it across the board in terms of our scale economies. We want to deliver great quality and great performance. And I think that the thing that sometimes gets lost in the mix, obviously, index prices have been coming down for quite some time, led by us over the past several decades. But sometimes it gets confused that we're all about index. We're actually about active and index. And really, if you go back to our origins, what Bogle was against was high fees. And so active management at a low fee can really outperform over the long term if delivered with the right quality. That was Bogle's hypothesis in the 70s and 80s. And if you look at our track record, even just in something like active fixed income, the empirical evidence backs up that hypothesis that he had way back then. 91% of our active fixed income outperforms its peers over the past 10 years. And one of the reasons why is because we price it at just over 10 basis points. And so at a very low fee. And, you know, when you speak to our fixed income team, to Sarah Devereaux, our CIO, and our teams who run our active fixed income, part of the reason they're able to outperform is they have a much lower headwind from higher fees, and so they're able to take risks in a much better and more disciplined way. And so what this is really about is not just about delivering high-quality index management, but it's really about delivering high-quality investment management at a very low fee. And I think whether you're looking at active fixed income or whether you're looking at index fixed income or index equities, that's really what we've been about.
Right. Well, Salim, you make the point that a lot of people probably think of Vanguard and they don't think of active. And you do have, of course, active funds out there, but it's a pretty small percentage of your overall lineup, especially if you take a look at the ETF side of things. Should we expect to see more active fund launches from you?
Yeah, you know, our active management, the first Vanguard funds were actually active funds, if you go back to the 70s, and both we manage our active fixed income within Vanguard. We have a whole range of partners, sub-advisors that we work with for our fundamental active equities. And they're unified by the principle of being high quality at a low price. And yeah, Katie,